Have you ever loaned something to a friend, like money, a laptop, or music? How could you be sure your friend would return the item or repay the money? What factors did you consider before loaning something to a friend? Well, you're just going to answer this sort of based on whatever you think. Um, and so I'll give you time, pause the video so you can answer that. All right. In your notes, read the scenario and decide which borrower should Sean lend to and why. So we've got three friends. They're at a mall shopping for Joe's birthday. Sean, Rachel, and Hayden all want to get him what he really wants, but there's a snag in the plan. When two of the three friends come up short on cash, after reading each of the friends' stories below, decide who Sean should loan his money to and why. So Sean works after school and on weekends, so he usually has money in his wallet. He wants to get Joe a new portable game console, which he can easily afford. His friends are always borrowing money from him because they know he saves, and today is no different. Rachel sees the perfect gift for Joe, but she only has $20, and the gift costs $100. She tries to convince Sean to loan her the money for the gift, explaining she only needs $80 because she can contribute $20. She reminds Sean that she borrowed money from him before and always pays back debts on time. As an added bonus, she tells Sean he can borrow her car and her tablet in case she isn't able to pay the money back right away. Hayden wants to buy a new video game for Joe, but he doesn't have the money right now. He borrows money from his friends all the time and has a reputation of being late on paying it back. Sometimes he forgets entirely. He tries to convince Sean to loan him $100 for the gift. So, who would you lend the money to? Well, I think it's pretty obvious that Sean should lend the money to Rachel. So Rachel has good credit because she's paid back before. Rachel has collateral, which is the car and the tablet that he can borrow, and the ability to make a down payment because she's paying 20 of the 100. All of that makes her a better candidate for the loan than Hayden was. All right, so we've got a few different definitions here for your notes. The first is collateral, and collateral is security given for the payment of a loan. So if you are buying a car, the car serves as the collateral. It means if you don't make the payments, the bank owns the car. They can take it back. Same thing with the house. Something like college is a lot harder to do that sort of thing. Which is why the federal government has a student loan program, because if the federal government seizes your degree as the collateral, they have nothing they can do with that. So that's why that is an unsecured loan. And then investment of money to gain profitable returns. So that's where you're taking your money and trying to have the money grow for you. Securitized loan is a secure loan that is protected by security or collateral to ensure loan repayment. So if you borrow a car or a house from our example earlier, then that is going to be a securitized loan. But if you're just borrowing money from a friend and they don't have something to give you to hold on to in case you don't pay it back, that would be an unsecured loan. Down payment is the amount of money paid up front at the time of purchase. So when we'll be talking about buying houses later this week, and when you buy a house, is usually between 5 and 20% of the cost of the house you would pay as a down payment. Same sort of thing works for a car. Anytime you're paying part of the money up front and then borrowing the rest, that works as a down payment. And that is important for the bank because the bank says, okay, well, if you borrow $30,000 for your car and the car costs $30,000 and then you drive it off the lot and then you don't make the payments, we can repo the car, but we can only sell the car for $25,000, for example. And so they're going to lose that $5,000 that they lent you that they weren't able to recoup in selling the car, which is why they prefer for you to make a down payment where you pay that $5,000 down so that you're not underwater on the car as far as they're concerned. And then credit is an agreement by which the borrower receives something of value now and agrees to pay the lender at a later date. So that would be sort of a different definition for the word credit than the score that you get that lets them know how likely you are to repay your loan. In this case, having credit is like where you're able to. It's the agreement. The agreement itself is the credit here. All right, borrowing money to buy a house is called a mortgage. A mortgage is a type of loan borrowed from the bank or credit union and paid back within a certain time frame. So I bought a house and I took out a mortgage. When people talk about mortgaging, they're just really talking about borrowing money to buy a home. And we make mortgage payments every month, but it can take many years to pay off the entire amount, often 30 years. With a house, with houses being so expensive, you typically would take out a 30-year mortgage so you can afford the monthly payments. Now, you don't have to take out a 30-year mortgage. You are allowed to take out mortgages less than that. And generally speaking, the shorter the time period, the less you will pay overall. And that's because you have less time for that interest to compound. And also because if you take out a 15-year mortgage instead of a 30-year mortgage, your lender will give you a better rate. So if you're thinking about buying a house, you have to look at all of those options. You look at how much you pay over that 30 years, how much you would pay over 15 years, and figure that out. When taking out a mortgage, banks also charge interest on the money borrowed, and a down payment is required to secure the loan. So most commonly set between 5% and 20%. So most places think that you should pay close to 20%. If you can, I would recommend paying down as much as you can, up to 20% at your down payment. But very, very seldom are you going to be able to take out a loan for less than 5%. Sometimes there's an example where you can do it for 3% in certain first-time home buyer sort of situations, but generally speaking, it's going to be 5%. So that would mean if you're buying a house for $300,000, you have to put $15,000 down. So why do you think you need a down payment? Well, when buying a house, paying anything less than 20% means you are a high-risk borrower for the bank. So you'll have to pay insurance to protect the bank's money called private mortgage insurance. So this is money that you don't get anything in return for and you will never receive back. So it can be kind of frustrating having to pay PMI because it's just money that goes down the drain. So if you borrow money for a house and you only maybe you only pay that 5% down in our $300,000 example, then you're going to be 15% short of reaching that 20%. And so in our example where we bought a house for $300,000, paid $15,000 down, we're 15% short. That means we're going to have to pay about $120 a month in PMI, and that's just money that just disappears from us. We just have to pay it. We don't get anything in return for it. It is for the bank to insure against us defaulting on our mortgage. So if at all possible, when you're buying a house, you want to pay 20%. Once you've gotten to 20%, that payment drops off. So they'll give you a schedule and they'll say, all right, well, once you get to such and such date in such and such year, you have paid off 20% of the house, and so you can stop paying PMI. That would be fine, but you might have paid PMI. You might have paid that $120 a month for a few years, and now you would rather just have that money. So PMI is something that you want to avoid if possible. So we'll talk tomorrow about buying an actual house and the process therein.